Lovely. Okay, hello everyone, and welcome to our first webinar back this year, 2025. We've got Sam with us to give his CBAM portfolio review and outlook for Q4. We believe that the presentation should take between 30 to 40 minutes. And as usual, obviously, we'll have some time for questions at the end for Sam to go through. Just pop any questions you have over in the question box or chat box over to your right-hand side, and we will go through those at the end. Otherwise, Sam, it's all yours.
Thanks, Jess, and good morning, everyone. Happy New Year, and let's hope we get some markets positive performance in 2025 in the same way we did in 2024. But last, let's look into how the last quarter and 2024 in general went. Mark is unfortunately not able to join me today. He's got another engagement. But you see there, for those who aren't aware, I am the portfolio co-manager. So I, alongside Mark, dictate the composition of the portfolio, as well as managing the team with looking at wider trends. Just to take a look very quickly at the notices, as we have to do, of course. This presentation is for information purposes and certainly does not represent any investment advice. Kate Berkshire is an authorised representative of Ascot Wealth Management, who are, of course, regulated by the FCA. And then just taking a look what we're going to go over here. I'm going to go over 2024 portfolio performance for looking at what we did in terms of trades last quarter and the factors within the markets that was affecting the performance of the portfolios in 2024. For looking under the hood as funds, a section I've been doing now for about a year, just so that we can help educate a little bit more on individual funds that are in everyone's portfolios. And then going on to taking a look at what might be happening this quarter and how we might be positioned for it finally. So 2024, apologies, it's an awful lot of data points on one graph, but it helps illustrate. So across all 10 portfolios, 9 out of 10 beat their benchmark for the year. So very happy with that. All of which were truly in excess of in positive territory. So very, very good for the year. In particular on the P portfolios, what we found was that the more risk averse portfolios, so the 1s and 2s rather than 4 and 5s, were really, really strong against the benchmarks. P1 was in excess of its benchmark by approximately 2.25%. And P2 was again over 2% ahead of benchmark. And obviously, as you imagine, as you go up through the risk ranges, that narrows. But apart from P5, all portfolios outperformed their benchmark there. The lowest return on the P portfolios was 5.7%, which, you know, considering money markets, we still had a very strong first half of the year. They returned 5.25%, so we were outperforming even a very strong money market for the year on the lower down portfolio. But P5 there, given 12.17% for the year, so a good return. When we look at the R portfolios, a bit more of a disparity on performances. So the R5 did actually perform really well at 15%. R1 was about 0.8% less than P1, which in fairness very much goes to show that the active funds were very much adding value in the P portfolios, which helps demonstrate the thesis that we're going for there. But 5 out of 5 beating their portfolio benchmarks across the year. When you look at the final quarter in this area, we see it was quite a choppy final quarter, dictated by we had the UK budget, which turned out to be a bit more debt spending orientated, let's say, than perhaps anticipated. And not just that, there's very much belief now that taxation is now at its peak level for income. So if you were to increase tax rates beyond this level, would actually start to harm receipts. There's obviously, you'd either be suppressing growth too much, or you'd find people would be moving their incomes to other jurisdictions. So of course, then it wouldn't be a benefit to the exchequer in that regard. Also, of course, we had the election of Donald Trump, and that was really, really important for the first quarter. So we ended up with a big change in sovereign debt yields as people realised that actually the Kamala Harris vote was nowhere near as strong as the polls have been illustrating. So that sovereign yields went up, which conversely means that, you know, the price of sovereign debt comes down. And then we had, once Trump got elected, this massive rally in equities on the basis of deregulation and reshoring of jobs, etc. But it's not necessarily all clean sailing as far as Donald Trump's concerned, and we'll come to that in a moment. The theme, though, with sovereign debt yields continue to rise up. That's been going on now for approximately 3 months. I think as of a day and a half ago, we probably saw the peak of that level. The 10-year gilt, so that being UK sovereign debt, 10-year, was very nearly hitting 5%, which is pretty much its highest level since, well, the noughties. So that now looks very attractive. In fact, we would like to increase allocation to gilt a little bit more, but I think we're at the limits of where we feel comfortable with. I'll talk a little bit more about sovereign debt in a little while. Just very quickly looking at quarter four, as I mentioned, the US was very much a top performer. Seeing there that the passive fund returning 10.7% on the quarter, with one of our two actives outperforming that by nearly 1%, and one of our actives actually underperforming that by about 1%. It's actually the first quarter that this fund here has underperformed the passive. So we'll continue to keep an eye on that, and we've got a cool book to understand the reasons why. We don't look at performance of any one fund quarter on quarter particularly hard, but we just need to understand why this was to help understand if it lines up with our own views for the future. Looking at the worst performance here, we have gold sold off by nearly 9% over the quarter, off the back of a little bit of a decrease in rhetoric from Mr. Putin, as well as you would have seen last night, the Israel-Gaza situation has started to unwind to a degree, which is very much beneficial for cargo flows through the Red Sea. At the moment, cargo is, instead of going through the Suez Canal, is going all the way around Africa, around the Cape of Good Hope, and up to Western Hemisphere countries up through that way. Obviously adding on much time onto their journey times, and of course adding shipping costs, which gets passed on to me and you as consumers at the end of the day. So with that unwinding, just helps, you know, bring a bit of inflation down, which helps bring golds down to a degree. Europe has had a not particularly great month, quarter down 4.25% there. This is a trend that we expect to continue for a little while, actually, which is why we are underweight it versus our benchmarks. The reason for that being is that we need to see an increased competitiveness in the European labour force before we see an improvement in the manufacturing sectors. Germany is obviously very much the key part of this. Germany has actually had 2 years now in a row of slightly negative growth. And German labour is expensive. And with an awful lot of their manufacturing coming from, you know, for example, cars, etc., well, you've got China bringing in an awful lot of very cheap automobiles now, which is undercutting it, which means their sales are coming right down. So it's will probably continue for at least another 6 months but of course we will keep it under review. So just looking at the trades, it was actually quite a quiet quarter for us for trades. With the volatility, it's important to find periods where it's a little bit quieter to do your trades, because we have to come out of the market for a day before we go back in if we switch between funds. And obviously we don't want to risk a market move being excessive and say we miss out on a 2% rise of one asset because we've been out of market entirely for a day. But looking, what happened was that as sovereign debt yields increased, we increased our exposure into sovereign debt just because of they were looking quite a bit more attractive in terms of real yields. The real yield of UK government debt over and above inflation at the moment is around about 3%. It's actually a very attractive yield on what is, in theory, a risk-free asset. So that gives a really stable point, for portfolios, for long-term investors to capitalize onto. And then, as what happened with obviously the Trump trades, there's a big flow into those markets. So we didn't want to become underweight those the US equities. So we found ourselves topping up there in November. We expect US markets to continue to be actually the driving force behind the equity markets for the year. Earnings growth looks reasonable there. Might be a little bit of a depreciation on technical factors, but overall we're expecting around about an 8 to 10% return on US equity this year, which is probably is one of the more attractive areas for equities probably this year. And then last month, an increase in our weighting towards our active sterling corporate bond holding over passive. This is because, frankly, the active manager has been doing such a great job and has proven the mandates that he's given and that his process is working. We have a lot of confidence in behind that. So we want to increase our weighting there to give an indication of how well he did last year. And this is something that he's done throughout his tenure. Last year, he outperformed the index by about 10%. So that has an awful lot of value, particularly in the lower down portfolios. Sterling corporate debt in the lower down portfolios makes up anything up to about a third of the portfolio. So that is a really, really important one for more risk averse investors. And then at the beginning of this month, timed it just about as perfect as we could. We reduced our currency hedge on our US equities. So what that has meant is that if you were to look at the local price of the S&P 500, so that being priced in US dollars, you would see actually on the year it's been, over the last month or so, it's actually been fairly flat. But if you were to look at it as a hedge, in floating sterling terms, it looks far better because of the pound has been devaluing. So us moving away from the hedge has helped support our sterling orientated investors, obviously. So that's been really helpful for helping to protect returns there on US equities this month. And as I said, it's been a bit more quiet. 13 trades last month compared to, don't get me wrong, we only had 12 in Q1, but a little bit quieter of a month. However, we think that the way the portfolios are positioned presently is looking quite good for certainly another couple of months. But we will be reviewing funds quite heavily this quarter, so we might end up with some fund changes rather than changes in sectors, if that makes sense. So looking at what was driving the markets, as I mentioned, US election, very much a theme of deregulation perhaps to go on to this year. However, what will be interesting is to see how hard they can actually get, how far they can go with that deregulation. Although the Republicans may control all three sectors of US government structure, legislative structure. Let's not forget there's an awful lot of factions within the Republican Party. So the Tea Party, for example, is very much not a fan of excessive debt borrowing, which is very much at odds with what Trump wants to do. So there's going to be a bit of negotiation within their own party to see how far they can go, I think, this year. On the tariff front, though, Trump wants to put a blanket 10% tariff on all imports from all countries apart from China. Within China, he wants to put it up to like another 30%. Very protectionist. Should bring more work into the US, which is why we're expecting a very strong dollar this year. As partly why we're expecting a more resilient US equity market than perhaps in other places. But what I would say, though, is that these policies are going to be inflationary. So they're expected to add anywhere between another 0.6 to 1.4% of inflation over and above the existing US inflation rate. And US inflation is proving sticky at around about 3.5%. So if that gets added on over and above, the expectation that the US Federal Reserve is going to cut rates further into 2025 is looking rather optimistic as far as we're concerned. So that's why we are very cautious with how we're treating the US at the moment, with making sure that people aren't being over optimistic as compared to what the macroeconomic reality is. Covers off the UK budget there. And the debt yields, I've got a couple of slides on in a second. Mentioned there that currency US dollar strength is very much expected for this year. How far that will go, we are not certain, but we are at the lowest amount of US dollar hedging that we've had in certainly my tenure, so at least 3 or 4 years. So we are very much keeping ourselves in the mindset that the dollar is probably going to be king this year, and that we are looking for an appropriate point that perhaps increase that back up, but I'm not expecting that for at least another 6 to 9 months from now. Debt risk premiums, got another couple of slides on that at the moment. Obviously, macroeconomic data, covered that quite a bit, talking about Germany there being slightly negative growth now for 2 years in a row. If you look at political risk, with France at the moment, they don't look like they can get a government at all to be stable for longer than 3 weeks. So there's going to have to be some degree of new elections or similar there, I'd imagine 2025, which would then possibly bring in Marine Le Pen into an even stronger position. And what does that do in terms of, as it's been called, Frexit? So quite a lot of volatility perhaps on Europe, but conversely, Ukraine war, it's quite likely to wind down to some degree this year. What does that look like? We don't know. We know that there has been discussions behind the back doors between the US and Russia on perhaps how this could play out. But I think that's possibly the last really bad macro point there for the year. Just quickly showing here across the 3 months the difference. Sorry, it's hard to get 2 slides onto one graph and it's to be really, really clear. So on the right-hand side here, we have the S&P 500 in dollar terms, which finished off the quarter just growing just over 2%. So that's in essence where a hedged position would get us. Whereas because sterling has depreciated, we see that the S&P 500 on the quarter grew over 9%, getting close to 10% there. So 7% extra there in sterling terms when you take away the hedge, and we think that's the thing that's going to continue for this year, is that a hedge position on US equities is not a beneficial place to be. So we're adding in a little bit of a free float there from a currency perspective. UK government debt yields. One thing that was really bugging me, if I'm honest, last week was everyone saying about how rising UK debt yields was very much a reflection on the the incumbent at number 11. That there is a degree of truth in that, but I don't think it's the primary narrative. US Treasuries have been, selling off quite hard for now, as you can see, since the beginning of October. And as you can see, in terms of correlation of what's been going on between US and UK, US is the primary mover of capital in the world. So if sovereign debts in the US is selling off, you find globally that this will be a trend. And as you can see there, the underlying shape of this is very similar. I do think, as I said, though, I think a day and a half ago might have been perhaps the end of this little phase, but we'll keep an eye. It really depends on what the budget proposals are from the Trump government, more than UK perhaps at the moment. But servicing costs of debt in UK is of particular highlight for a lot of people at the moment. And just to highlight that this isn't just the Anglosphere, even Germany has exactly that same movement over the last few months, literally to exactly the same point at the beginning of October. So don't get me wrong, the recent budget did add on a degree of particular UK sell-off over and above, but that happened long ago, and it isn't the narrative behind what you've been seeing in the news over the last few weeks. That's far more driven by what's been going on in the US than actually in the UK. And just continue that. Literally, you've got a really diverse basket here of currencies versus the US dollar. Anything below 0% here is a depreciation of that currency versus the dollar. There's literally not one currency that has outperformed versus the dollar over the last 3.5 months. So US dollar has very much been king. Risk premium in bonds. So what this is so if a bond is saying is yielding 7%, but the equivalent government bond is say yielding 4%, then the difference between the two is the risk premium spread. So basically the risk of default from the issuer of default. And what we see here is this is over a really long timeline. This is over 26, 27 years, this graph. And as we look over here, we see US and European spreads really compressed. So by that, what I mean is that typically you'd be avoiding corporate debt just on the expectation that that spread is only going to go into one direction, and that is up, which means that corporate debt be losing money compared to government's debt. And that's why at the moment, despite the sovereign debt prices going up, we've been favouring that over corporate debt, just because of how tightly this extra risk premium is to hold a riskier issuer at the moment. So this is at a real cyclical low, and even our high yield debt manager has been talking very not very pessimistically, but cyclically pessimistically now for about 3 or 4 months. So even if your own fund manager of that sector is talking a little bit pessimistic, that gives you kind of a signal that perhaps you need to be moving elsewhere to a degree. So that's why we were going to sovereign debt, just so that it helps protect returns as and when, as it will do at some point. As you can see there, that spread will open up. So it's just helping us protect what's going on in the portfolios there. Don't get me wrong, nothing to say that necessarily that will open up massively this year. Corporate earnings are good, but there will be at some point in this cycle, investment cycle, where that will open back up. So it's about being prepared for that, and then ready to re-enter when we start to approach more the kind of like 5% kind of region. That would be more attractive for us. Just taking a quick look at a fund in particular. So this was a new edition, I think, right at the end of Q3, so probably about September now. Held it for 4 months. It's an emerging market fund, so this is where we moved to after China when we exited that. And it's got a really, really good team behind it. It's very much computer model driven with a degree of human oversight. So it reduces the bias of humans to particular factors, but it doesn't allow a model to just carry on working, and inevitably, as you know, bad information into a computer model results in bad information out. So it helps check what's going on there, and there's a good blend there. It looks at how companies are priced over an economic cycle compared to what they are currently being valued at. So it's looking for companies with potential earnings growth, but are still priced reasonably. So GARP stands for Group at a Reasonable Price. So growth at a reasonable price. As you can see here, it's outperformed its peers and its benchmark very well over the last 10 years. Circa another 40% over 10 years, so roughly 4% year on year. In simple terms, increase, particularly in the post-COVID environment. We've been having quite a lot of spread in what's been happening across the emerging markets, particularly as obviously China hasn't been performing that great for the last 5 years. And I think that's an awful part of where this comes from, is it notices where these companies are perhaps being overvalued. A lot of investment management is about avoiding those that are valued poorly compared to trying to find things that are attractive. I think if you avoid the bad elements in investing, you're more than halfway there. So I think that's very much what this team have been doing. And as you can see, it does work over the longer term. Going back to 2016, it's only 1 year where they were underperforming their peers, and that is in 2020, which obviously was COVID and a very particular and odd market environment with the amount of money being injected into markets by central banks. So I think there's an understanding of why that occurred there, but otherwise, every year since 2016, outperformance. So that's what we're looking for. We're not looking necessarily for one fund that will outperform massively in 1 year, but might not perform the next. We just want just a good degree of consistent performance. That's the things that we're looking for in any active fund. It's about how do they earn their management fee consistently. I won't read that in full, as you can imagine. That's an awful lot on one slide. But in that sense, what happens is that they look at a variety of factors, such as what is the momentum behind their earnings, what's driving that, along with how resilient is it throughout earnings cycles. So obviously there are recessions, how resilient is it in those recessions, and growth prospects, but also looking at how it is valued in comparison to markets. So admittedly this is for the UK fund rather than the emerging market one, but Imperial Brands, you can see very clearly here they've started to become a disconnect towards the end of the 2010s, very much showing that there is still very much value in their earnings there, very resilient. Obviously you had COVID, had a bit of a mini recession at times, but very, very resilient. Even when you look at, say, the 2008 area, very resilient, but they've become detached from the share price where its theoretical earnings value is. So you can see that there is that potential, and it is recovering against that. So that's very much what this fund is looking to do, is finding those pockets of value within companies that have good growth and earnings potential over the economic cycle in general. Yeah, I think I covered all of that there. Do apologise. I'm on the verge of sneezing, so just be aware. I'm trying to hold it off just for a little bit longer. So looking at this quarter, as I mentioned, US, how far and fast on trade policies? Not entirely certain. As we know, with the art of the deal, you go in controversial and pretty heavy, straight away, and then you negotiate your way back to more softer ground. So we'll see where it goes. UK inflation bottoming out, probably are, as there's a variety of inflationary factors in the world, particularly coming out of the US. It will add inflation everywhere, just not to the same degree. One thing that could potentially help UK is if the oil price drops down. That could possibly help very much. Obviously, we are quite reliant on trade now when it comes to our energy resources. So that is one thing that could bring it down, but otherwise I'd imagine it'd stay in this region between 2.5% to 3.5% for the remainder of 2025. UK data, as you know, has been softening, spending has been softening. That will get reflected into the figures at some point compared to where they were expected to be 12 months ago. Covered government bonds. PMI data, so that's management data out from actual managers of companies. So regards to their confidence, regards to their company situation. In Europe, that is very poor. So 50 is considered a neutral ground between growth and decline. German manufacturing, I believe, actually starts with a 3 now. It's better than trillion to negative territory. It might be just above that into the 40s, but it's somewhere in that area. So really quite contractually. The US actually for services looks really positive. It's about 55. So that's what I mean. Looking at those factors means that we're not that keen on Europe at the moment, and US looks a bit more positive. Q1 earnings season kicked off last night. Haven't quite yet had a chance to have a look at the earnings reports. I will do when I get to my desk. Obviously, I was making these slides this morning. And looking at UK mid and small cap valuations, there's no two ways behind this. They are incredibly cheap at the moment. They are priced almost as if there is a full recession about to happen, and that just is not the case. They are, even if there isn't on valuation factors a recovery this year, they are demonstrating very good earnings yield, and it may just be a good place to just have money and just collect that earnings yield for the year and not expect any growth on a technical factor. So that could be quite positive there, just to buy and hold. Portfolio positioning summarizes where we are. Unfortunately, there's an awful lot of rows on this table and it's difficult to get it very clear. But as looking at North America here, we are neutral on equities, just keeping up the benchmarks, just because the benchmarks are rather US equity heavy at the moment. That's the kind of the sandy color. North American fixed corporate versus government. We're neutral on North America fixed income in general, but we're preferring sovereign over corporates for reasons I mentioned. Just those spreads are incredibly narrow. Favouring mid cap and small cap UK just because of how cheap it is. Though up in the higher up portfolios, we have added we are a bit over on the FTSE 100 as well, just because of it does give a little bit of an inflation hedge just due to the way the FTSE 100 works. And then finally, looking at this, we have an overweight on absolute return, which is our structured products fund that I discussed in the last webinar last quarter, but just produces in a flat environment circa 9% yield there. And if it is possible to get a positive return on that across 12 months, even in a declining equity market. So that's the reason why it's held there. Just it's a really good performing fund if there's a fairly flat year. but obviously it does still produce positive returns in good years, but it just helps to add in a little bit of resilience into portfolios. So that brings me to an end in 35 minutes, which I'm quite glad about because that's just about where I thought I was going to be.
Lovely. Thanks, Sam. So we haven't actually had any questions come through at the moment. So if you have got any last minute ones, you've got the next couple of minutes just to pop them in. Just a couple of things from me, just to remind everyone that if you sign up for these webinars, then you do receive a copy of the webinar recording and slides, and that'll be emailed out to you normally within the next 24 hours. And obviously, if you do have any questions on the back of that, I'm sure you can get in touch with Sam or Mark, and they'll be more than happy to go over anything that you need clarifying. I am going to pop a small survey up as well at the end of the webinar. So if you do have a minute, then please do leave your feedback. I'm sure the guys will really appreciate it. And if there's anything that you would like to see included in these presentations, then again, suggestions are welcome. Otherwise, we do have our first AWM webinar in February. We have Claire to talk about tax year end, so we will see you then.
Obviously, I know sometimes asking questions in the public space can be a little bit nervous. I'm particularly bad for that one. But if you want to ping an email across to the team to ask a question, then it's invteam@capeberkshire.co.uk. Otherwise, thank you very much.